Hey everyone, I recently created a video on best mutual funds in India where I discussed why index funds are important and within index funds, why you should invest in Nifty 50 based index funds. While Nifty 50 based index fund is a great option and should be a part of your portfolio, the only problem with Nifty 50 based index fund is it replicates only the top 50 companies of India that are already large caps. And if you recall, I mentioned that ideally there should be a Nifty 500 based index fund that would replicate the top 500 companies of India that would include your large caps, mid caps and small caps. So that you may enjoy the stability of large cap companies and mid cap and small cap companies have better return potential as compared to large caps. However, since index fund that is passive funds in India are relatively new, currently the most popular index fund are Nifty 50 based index funds. And I also said that as the Indian stock market would mature, we will see index funds that would replicate the entire Nifty 500 index. On that, I received queries to review Motilal Oswal Nifty 500 index fund, which is currently the only index fund in India that replicates Nifty 500 index. So in this video, we'll first understand what is Nifty 500 index, then we'll look at Motilal Oswal Nifty 500 index fund, and then we'll compare the performance of Nifty 500 index versus Nifty 50 index. Finally, we will conclude if it is worth investing in Nifty 500 based index funds or not. Alright, let's get started. Okay, to begin with, let us first clearly understand what exactly is Nifty 500 index fund because there is still a lot of confusion for this index. In simple language, Nifty 500 index tracks the performance of top 500 companies of India. So if you break Nifty 500 index, it includes top 100 large cap companies of India. These large cap companies may help you generate a stable return without too much volatility. Then you have 150 mid-cap companies that are growing businesses that have higher return potential but obviously comes at relatively higher risk. Then you have 250 small-cap companies that are even smaller but have great potential to generate high returns but comes at high risk. So essentially Nifty 500 is a combination of 100 large caps, 150 mid-cap and 250 small-cap companies that combine to form Nifty 500 index. The best part of this index is that it has potential to offer good stability due to large cap companies in the portfolio as well as potentially generate better returns as compared to only a large cap index over medium to long term. Here the most important point to note is weightage of large cap, mid cap and small cap stocks in the portfolio. You might think that since there are only 100 large cap companies and 150 mid cap and 250 small cap companies in Nifty 500 index, Nifty 500 index will have higher weightage of small cap and mid cap. That's not how it works. In fact, this Nifty 500 index has close to around 75% weightage of top 100 large cap companies. The next 150 mid cap companies have a weightage of around 15% and remaining 250 small cap companies together have a weightage of around 10%. It means if you invest rupees 100 in Nifty 500 index, you're around 75 rupee would be invested in top 100 large cap companies, around 15 rupee would be invested in 150 mid cap companies, and around 10 rupee would be invested in 250 small cap companies. The reason is simple. Weightage of each stock in the index is decided on the basis of free float market cap. This free float market cap is nothing but total number of shares minus promoter share multiplied by share price of the company. Now since top 100 large cap companies of India are very large cap in terms of market cap with relatively higher free float market cap, they enjoy a higher weightage in Nifty 500 index. Here it is very important to note that this Nifty 500 index is reviewed twice a year to make required changes in the index. Now as stock prices changes every day, accordingly the weight of each stock in the index would change. So the money that would be invested in top 500 companies of Nifty 500 would be decided based on the weightage of each stock on that particular day. I hope it makes sense. Now as far as Nifty 500 sectoral composition is concerned, the highest weightage is of financial services, which is currently around 31%, followed with consumer discretionary sector, then IT sector forms part of top 3 largest sector in the index. If you look at the weightage of top stocks in Nifty 500 index, it includes Reliance with around 7.6% weightage, then HDFC Bank with around 5.7%, then ICICI Bank followed with Infosys, HDFC Limited, TCS, ITC, Kotak Mahindra, L&T and then HUL. Interestingly, Nifty 500 index covers around 92% of India's listed stocks. So there are around 1600 companies listed on NSE out of which top 100 companies that constitute Nifty 500 index represent 92% of listed universe in terms of market cap. If you look at this data in terms of market cap, the total market cap of all listed companies in India is around 2.7 lakh crore. Out of this, Nifty 500 companies have a market cap of around 2.5 lakh crore. That's nearly 92%. So if you believe in India's growth journey and want to invest in Indian economy, then Nifty 500 is a brilliant option with around 92% weightage of total India's listed universe. Now I did some research on return of Nifty 500 over the last 10 years and here are my results. So this table represents Nifty 500 index return over the period of 1, 3, 5, 7 and 10 years. Please note that this is as of 31st November 22. So if you had invested in Nifty 500 index in SIP form, then in last 1 year the returns are 17.4%, 3-year returns are 23.4%, 5-year average return are 17.8% and likewise 10-year returns are 15.1%. And if you have made an SIP of rupees 10,000 on first day of every month, then in 1 year you would have invested 1.2 lakh, that would have become 1.3. In 3 years, 3.6 would have become 5.05, 6 years, 9.36. Likewise, in 10 years, your 12 lakh would have become 26.4 lakh. Clearly, the returns are fantastic. I even compared Nifty 500 returns on rolling basis with Nifty 50 return along with volatility. We'll look at it shortly. For now, let us understand how you can invest in Nifty 500 index fund. So far, we discussed why Nifty 500 index is an excellent option for investment. Now, the important question here is how to invest in Nifty 500 index. We can't invest in an index directly. We need a fund that replicates the index and invest the money in that index. So as of now, there is only one index fund that replicates the entire Nifty 500 index. That's Motilal Oswal Nifty 500 index fund. This would exactly replicate the Nifty 500 index as per the weightage of each stock in the index. I had a look at the fund details. So this fund was established in September 19 and currently has an AUM of around 388 crore. One of the reasons why this fund doesn't have a high AUM as of today is due to the fact that people still lack knowledge on index funds and are still more inclined towards active mutual funds. And those who have started investing in index funds are mainly investing in Nifty 50 based index fund. But I'm sure going forward, as the awareness towards Nifty 500 index fund would increase, this fund would see more inflow of money. Next, if we look at the expense ratio, it has an expense ratio of 0.4% for direct investment. So expense ratio is attractive given the investment opportunity set. Next important factor is tracking error. In last 1 year, Motilal Oswal Nifty 500 index fund had a tracking error of 0.05%, which is very good. And since inception, this tracking error is minus 0.65%. As far as returns are concerned, we have already discussed Nifty 500 index return. Since this Motilal Oswal Nifty 500 index fund aims to replicate the Nifty 500 index, the returns would also be similar. Of course, you need to consider the tracking error. If you want to research further, you can get all product related details on their website. I have provided the website link in the description. Now let us try to understand key difference between Nifty 500 index and Nifty 50 index. So first difference is Nifty 50 index include top 50 companies of India, whereas Nifty 500 include top 500 companies. While Nifty 50 only include the large cap companies, Nifty 500 include large caps, mid caps and small cap companies. Then second difference is if we look at the sectoral composition, Nifty 50 top 3 sectors include financial services with weightage of around 37.2%, followed with IT with around 14.4% allocation, then oil and gas and consumable fuel with around 13% allocation. Whereas Nifty 500 index top 3 sector include financial services with around 30.9% allocation, then consumer discretionary with around 13.5% allocation, and then IT with around 11.7% allocation. So both Nifty 50 and Nifty 500 have financial services as top sector, but the weightage of this sector is lower in Nifty 500 that comparatively reduces the sector concentration risk. By the way, Nifty 50 consists of total of 14 sectors out of 21, whereas Nifty 500 covers all 21 sectors. Then top 10 companies weightage in Nifty 50 is around 58.2%, whereas in Nifty 500 it is around 38.9%. So Nifty 500 is more diversified in terms of both sector and stock weights. Now I have gone one step ahead and analyzed Nifty 50 and Nifty 500 risk versus return over a period of 15 years. Let me show you the results. So this table represents Nifty 500 versus Nifty 50 risk versus return comparison. And if you look at it in last 1 year, by the way, again, this is as of November 22. So if you look at it in last 1 year, while Nifty 50 has generated return of 11.9%, Nifty 500 return is 10.2%. In 3 years, Nifty 50 return is 17.3, whereas Nifty 500 return is 18.9. In 5 years, it is 14.3 for Nifty 50. Likewise, it is 13% for Nifty 500. Likewise, in 10 years, Nifty 50 has generated 13.7% return, whereas Nifty 500 return is slightly higher at 14.4%. So historically, in last 10 years, your Nifty 500 returns are slightly better than Nifty 50 returns. And if you look at the annualized volatility, in 1 year, Nifty 50 volatility is 17.6%. Again, same for Nifty 500. But in 10 years, if you look at it, Nifty 50 volatility is 17.1%, whereas Nifty 500 volatility is again 16.8. So in terms of volatility, again Nifty 500 has lower volatility as compared to Nifty 50. Now if you look at the rolling return comparison between Nifty 50 and Nifty 500, this is the data between November 7 till November 22, and this is for 3-year rolling return and 5-year rolling return. If you look at it, the average return of Nifty 50 in 3-year rolling period is 11.7%, whereas Nifty 500 average return is 12.1%. And if you look at the median return is 12% for Nifty 50 and it is 12.9% for Nifty 500. Whereas in 5-year rolling return, the average return is 11.7% for Nifty 50 and 12.1% for Nifty 500. And median return is 12% for Nifty 50 and 12.9% for Nifty 500. So again, in rolling return comparison, your Nifty 500 returns are slightly better than Nifty 50 returns. I hope now you got a good picture of Nifty 50 versus Nifty 500. Now let us conclude if it is worth investing in Nifty 500 index or not. After the research I have done, I am pretty convinced that Nifty 500 index is worth investing my money. The simple reason is, A, it gives me a good exposure with around 75% allocation in large cap and remaining 25% exposure in mid cap and small cap sector. Of course, this allocation would keep changing slightly on a daily basis. This could provide both stability and can potentially generate high return. And B, it provides a better diversification at lesser risk. So in addition to my SIP in Nifty 50 index fund, I have also started an SIP in Motilal Oswal Nifty 500 index fund. Now you tell me, what is your view on Nifty 500 index fund? Is it worth investing the money? Let me know in the comments. And if you want me to cover any specific financial topic, do mention it in the comment. And if you found this video useful, do share it with your friends. I'll see you next video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.